What's going on, everybody? Alright, because the sales returns and allowances, and basically sales transactions overall for a merchandiser with these new revenue recognition standards are kind of difficult, I thought it would be nice to create this little quick example with a nice little problem worked through just to kind of illustrate the whole process here. Alright, so I've created this problem right here, and I'm going to post this in Blackboard as well. But it's a problem for sales returns and allowances. So it's just 4 separate transactions that it wants us to record here for Wentz merchandisers. And so I'm going to go ahead and walk through these, and then I have journal paper over here in Excel where we can record these transactions happening. Alright, so Wentz merchandisers, it says they recorded the following transactions. It tells me on December 30th, Wentz sold merchandise costing $10,000 for $17,500 on account, with credit terms of $215 net $60. All right, so remember first, this $215 net $60 right here, that means that if these people pay us within the discount period, they'll get 2% off within those 15 days, or they owe the net amount within 60 days. And also remember, if we think there's any chance that they're going to pay us, which we always do, within that discount period, then we have to record that discount right away. Have to record it up front based on those new revenue recognition standards. Alright, so on December 30th, then what I'll do is I'll record the following journal entry. Alright, so I got December 30th here as my date. Alright, so remember, anytime we have these sales transactions, it's actually 2 separate journal entries. So the first thing that I'm going to do is I'm going to debit accounts receivable, and I'm going to credit sales revenue. Alright, and I'll just throw the calculation right down here just so we can see where it is that we're getting these numbers from. But remember, the calculation for this one would be, because we're taking that discount away right away, we got to figure out what that discount is. So 17,500 times 0.02. And what I'm going to do is I'm just going to say I'm going to take 17,500 minus 17,500 times 0.02. And really, that's what the calculation will look like. Alright, so I'm just going to figure out what that is right over here. So 17,500 times 0.02 gives me $350. That means these amounts will be recorded for 17,500 minus that $350. That tells me I'll record this debit and this credit both for $17,150. Alright, remember, I also need to record the fact that I've removed these things from my inventory now because I've sold them. So I'll debit cost of goods sold, that new expense account that we get to work with in this chapter, and I will credit inventory. So debit to cost of goods sold, and credit to inventory, and it told me those goods cost $10,000. So I don't need to worry about doing any sort of discount on that. The inventory didn't cost any different because these people may or may not pay me within the discount period. So I don't need to worry about anything else for that one, alright? Alright, so the next transaction that happens here, on the next bullet I see, it says Wentz had sales for the year of $4 million with a total cost of $2.5 million. And it tells me that Wentz estimates that approximately 3% of sales will be returned. And it wants me to record the appropriate adjustment that I need to make on December 31st. So remember, what we talked about last class with these merchandising companies is that they have to make sure that they estimate at the end of the year how much they expect that they're not going to get, because they have to record that adjustment. They have to create these allowance accounts for how much that return is going to be. All right, they have to do this because they can't record revenue at a bloated number, right? They can't show revenue that's too high in this year and then reduce revenue next year based on returns that happened as a result of this year's revenue. All right, so that we have to make sure we're following actually 2 principles with this one. We got to make sure we're following that revenue recognition principle, and we got to make sure that we're following that matching principle. So we have to make sure that we're matching the expenses and the revenues together in the same period where those revenues or those expenses matched, all right, where those expenses help create that revenue. Alright, so again, we got to record 2 separate journal entries for this one as well, because we have to create the allowance not only for the refund that we think we're going to have to make and the reduction in sales, but also an allowance for the inventory that we expect we're going to get back and the reduction of cost of goods sold. Alright, so a 2-part journal entry one more time here on December 31st this time. The first thing I'm going to do is I'm going to debit sales revenue because I want to reduce that revenue amount to an amount that I actually expect that I'm going to get. and I'll credit this new account, this liability account called refund liability. And again, this refund liability, one more time, it's just an allowance that we set up to cover any returns that happen based on this year's sales. All right, so I'm going to record this transaction. Here, you know what? I'll throw the transaction, the calculation for the transaction down here like I did last time. So this one will just be the $4 million of total sales multiplied by the 3% that we expect to be returned. So 4 million times 0.03 will be my amount for this one. Calculation there in the cell tells me that I'm going to record this transaction for $120,000. All right, but remember, I got to record that second entry here as well, because I have to record the reduction in cost of goods sold and set up that allowance account for the inventory that I'm going to get back. All right, so I create this new asset account called estimated returns inventory. So estimated returns inventory is debited, and cost of goods sold is credited to reduce. Remember, crediting an expense account brings it down, so I've reduced this expense account by crediting it. So a debit to estimated returns inventory and a credit to cost of goods sold. One more time, let me throw the calculation down here so you could see where this one's going to come from. Looking back at these numbers over here, total cost of goods sold was $2.5 million, and I expect that 3% is going to be that return. So I just take that 2.5 million and I multiply it by 0.03 or 3%. Alright, so that calculation results in a transaction value here of $75,000. Alright, so again, I've set up this allowance here, this allowance for the refunds that I think I have from this year's sales, and this allowance for the amount of inventory I think I'm getting back. Alright, now remember, anytime we have a return, and anytime we've had a return throughout this whole year, these are the accounts that we work with when that actual return happens, right? We get it out of that refund liability account instead of reducing sales revenue for an amount that might not match this period. And then we get it out of this estimated returns inventory instead of reducing cost of goods sold, again, when it may not match that period. Alright, so moving on to transaction number 3 here. It says on January 3rd, merchandise with a sales price of $1,500 and a cost of $750 was returned to Wentz. This return is related to that December 30th sale. Alright, so recording this transaction for January 3rd then. Put my JAN in here because this is a new month. And this is the 3rd of January here. Alright, so remember, it's related to this sale that I already recorded up here. The sales revenue of $17,150. My problem is remember, when I recorded that sales revenue, I recorded it at that net amount with that discount already taken out. So I can't record this return now at a gross amount. Alright, so I got to make sure that I understand I have to record that discount on this return as well, because I want to take it out at the same equal value, like terms and math, right? I got to take it out at the same value that I put it in for. Alright, so this one's going to be 2 journal entries again, because again, I got to reduce the fact that their accounts receivable, the fact they don't owe me as much money. Alright, I do that with this allowance account that I created, a debit to refund liability. And then I credit accounts receivable to bring down their account. Alright, so a debit to refund liability and a credit to accounts receivable. The amount for this one would just be, if I flip back here and I see the amount, it tells me it was had a sales price of $1,500. Remember, we took that 2% off of there, so it'll just be $1,500 times 0.02. 1,500 times 0.02. There we go, so that results in an amount for this one. 1,500 times 0.02 of $30. Sorry about that. So a debit to refund liability and a credit to accounts receivable for $30, and then I have to do one more journal entry to put this inventory back. All right, so I debit inventory, and I credit one more time this allowance account that I just created on the 31st, estimated returns inventory. All right, so a debit to inventory and a credit to estimated returns inventory. No special calculations for this one. I just recorded at the cost. So the cost of what was returned was $750. Oh, shucks, you know what? Let me make sure I record that first one for the correct amount. So that 30 was just the discounted amount. I got to do the same thing I did before. Sorry about that. So it would be 1,500 minus that 1,500 times 0.02. Sorry about that. Alright, so that results in an amount of 1,500 minus 30, or 1,470. My bad. Oops, forgot my equal sign there. There we go. So 1470. My fault. Sorry about that. All right, so that's the way that I would return this, or sorry, that I would record this return there on January 3rd. All right, the next transaction that happens then is on January 11th. It says Wentz received the amount owed from the sale of December 30th. All right, so remember here it says they had 15 days to pay and still receive that 2% discount. It looks like this was 12 days or 13 days later, so within that 15-day window, so they're going to get their discount on what they're paying me. All right, so this journal entry will actually be pretty simple. It'll just be a debit to cash and a credit to accounts receivable for the amount that they owe me. I don't have to record anything else here. I just got to figure out what that amount is. All right, so if I look back at the very first amount that I said they owed me, all right, all the way back up here at the top, I said they owed me $17,150, and then I'm going to subtract out the amount right here, $1,470, of their return. All right, that tells me they owe me a total of $15,680, so that is what they will pay me. So it'll be a debit to cash and a credit to accounts receivable of $15,680. All right, I hope working through this example has helped you. Again, what I'll do is I'll post this solution that I've created here in Excel, as well as the actual example from Word into Blackboard, right below this video. All right, so good luck working through these. Let me know if you have any questions at all. Thanks, guys.